5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. December cut in question. Fed officials show uncertainty, perhaps, over rates, bolstering the hawks case for standing pat next month. Schmidt, Logan and Bostic on deck today. Tumbling. Those rate cut doubts putting risk assets down. Crude oil rising on mounting worries over Russian flows. And a tariff rethink. President Trump set to lower levies on food items from beef to bananas to address voter concerns. He's also going to be expecting a visit from MBS at the White House next week. Now let's take a look at these markets because we are pointed lower on futures once again today. We had a rough day yesterday, it must be said. 1.66% lower on the S&P 500, more than 2% lower on the Nasdaq. But it was a sell everything day, and the last time we've seen that was actually August, so it's been quite a while. Let's take a look at the bond universe because we're definitely seeing a hawkish repricing of the curve, and that potentially speaks to what I was just mentioning, how perhaps the balance is now in favor of the hawks, or at the very least pricing odds are coming down for a December rate cut. So we're just above 50% now, basically 50-50. We're at 3.58 on the 2-year yield, 4.12 on the 10-year yield. I also want to point to the UK 10-year yield. So we are off our lows, but gilts plunged at the open on this idea that Rachel Reeves might be doing a U-turn on some tax increase ideas. Again, pairing those gains for the yield, the 10-year yield at 4.50. And let's take a look at some commodities because we continue to see gold and silver rising. It's a 10% move for silver. We didn't quite hit that record even intraday yet, but we are still on record watch, although we've pulled away from that $54 mark. Gold just below 4,200. Bitcoin just falling off a cliff. Apparently, it's still, though, above $96,000. And crude putting on about 2% on the idea that that glut might be met with less input, if you like, because of rougher sanctions and also those strikes from Ukraine on Russian ports. All right, well, let's get to some individual stocks to watch now. Over to London and Kriti Gupta. Good morning, Kriti.
Good morning, Bonnie. We'll start off with the biggest mover to the downside, and that's Applied Materials. They came out with their earnings yesterday. They said they had a rough quarter in the past, and they're going to have a rough quarter right now. They're putting the blame when it comes to trade restrictions with China. Those shares down about 5%, and really creating a not so fun and rosy picture for tech here in Europe and, of course, in the United States. Applied Materials down about 5%. It's not all gloomy, though. Warner Brothers is one stock that's moving to the upside. They came out with a report after the bell yesterday, so 5% rally post-market on a Wall Street Journal report that Paramount, Comcast, and Netflix are starting to prepare bids to take over Warner Brothers. The deadline has previously been reported as November 20th. You've also seen the CEO of Warner Bros. Discovery, David Zaslav, get a tweak in his contract to keep some of that pay. So a little bit more sincerity that a bid, a buyout is actually coming. Those shares higher by almost 4% in the pre-market. I'll end with Siemens Energy delivering a very incredible, impressive earnings report in today's session here in Europe. They're really being rewarded. Turbines, data centers helping their bottom line. Bonnie, those shares higher by 10%.
All right, Kriti, thank you so much. Kriti Gupta there in London. And later this hour, we'll speak about all of this with Max Kettner of HSBC. Now, the Trump administration pushing the affordability message.
I think that one of the things that people have been talking about just the last few days is thinking about changing tariffs for foodstuffs and things. So tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space.
So President Trump now preparing tariff cuts and a series of new trade deals as he seeks to address voter concerns over the cost of goods. Joining us is Bloomberg Managing Editor for the U.S. Economy and Government, Mario Parker. So, Mario, Paul Donovan, UBS economist, pointing today to these Mercosur trade pact agreements and saying that, what can be negotiated is limited. What do we know about these frameworks?
Yeah, so far what we know is that the administration is looking to carve out some type of framework with 4 countries, Argentina, Ecuador, El Salvador, and Guatemala. A lot of that revolves around commodities, foodstuffs. In particular, we're talking about beef, coffee beans, bananas, vanilla beans as well. Some of those things that Americans typically buy at the grocery store. And as you mentioned, Vonnie, expressed quite a bit of pain at the voting rolls this time a week ago.
Yeah, exactly. And the administration certainly took notice. Now, separately, Mohammed bin Salman is headed to the White House on Tuesday. We all remember that Big meeting in Riyadh where he welcomed President Trump earlier this year. What will the Crown Prince want to get out of this White House meeting?
Well, given the Israeli strike on Qatar earlier this year, one of the things that MBS will be looking to get is a more definitive type of defense agreement or understanding with the U.S., something similar to what Qatar was able to emerge with an executive order. Not necessarily a defense treaty or pact, but something that lays the breadcrumbs for that as well. He'll also want the U.S.'s vaunted F-35 planes. That's a source of contention there because Israel is the only country within the Middle East region that has those stealth fighter jets as well. President Trump has hinted at an openness toward that, but that remains uncertain. And then there continues to be just some consternation over chips. And on the U.S. side, there's just worries about some of the controls that could make their way toward China. But on the Saudi side, the Saudis want to see the follow through on chip deliveries from the likes of NVIDIA as well. One of the things that you kind of hinted at it is that we'll expect a lot of pomp and circumstance. President Trump quite likes MBS. He's signaled that throughout both his first and second terms as well. So he will be feted as he arrives in Washington early next week.
Yeah, and a big history between the two. Back to the domestic arena and economic data. Mario, what do we know about what we can expect and when we might be able to expect it?
Well, there's a lot of uncertainty, and that's clouding so much from Federal Reserve decisions to just more clarity from other bodies as well. We expect to have some September data for sure, but the October data, the White House is saying we just may not get some of that data on the likes of CPI and such as well. We'll be very reliant on some of that private data that we've leaned on over the last couple of weeks as we've endured this shutdown, but so much is just uncertain right now. And that's not even to mention the impact as the government gets restarted in light of some of the DOGE cuts and the staffing cuts that occurred earlier this year as well.
Oh, gosh, that's all to come. Finally, on trade, Korea says we now have a fact sheet with the United States on trade and security. What do we know about the deal with South Korea?
Well, one of the things we know about the deal with South Korea is both that it revolves around this $350 billion commitment to invest in key U.S. industries, whether that's U.S. shipbuilding, chips as well, some submarines. There's some talk about whether or not the two countries will work together on some type of nuclear-powered submarines, either in South Korea or in Philadelphia in the U.S. as well, and what that means going forward. Again, we need a little bit more clarity there, but that was flicked upon in the MOU, and then we also had some reporting that was a source of discussion as well between the two countries.
Yeah, absolutely.
A lot of it is this fund just to invest in the U.S. as well.
Mario, thank you so much. A great set of context there for us going into the Friday trading session, and that is Bloomberg's Mario Parker. UK markets plunged into fresh volatility as speculation about the budget heightened uncertainty over the nation's fiscal position. The pound and gilts have bounced off earlier lows, but there were reports that Chancellor Rachel Reeves is rolling back some income tax increase ideas ahead of the UK budget due to perhaps better economic forecasts from the country's fiscal watchdog. So for more now and maybe some clarity, let's bring in Bloomberg's Lizzie Burden. So Lizzie, what do we know now that the market didn't know at the open when we saw gilts plunge and the pound was already weaker?
Well, let me take you back, Vonnie, because at first we thought it was a case of Reeves always chickens out. She couldn't get the spending cuts past the left of her party, and she couldn't get breaking the manifesto and raising income tax past the left of her party. It seemed like she was chickening out because of all of this speculation around the leadership, the challenge from the Health Secretary, Wes Streeting, that we had reported, which he denied, by the way. But then we had this clarification. So sources saying that she is dropping income tax income tax rise, but not because of political pressure, because, as you say, of this forecast expected to be better. And those sources telling us that actually she's still going to be able to deliver more headroom than she did at the spring statement and the last autumn budget. That was £9.9 billion. We know that it's left the markets speculating all the way to the next fiscal event of what she would do next. Actually, these sources saying that she's going to deliver £15 to £20 billion. Look, the original U-turn headlines, the market didn't like one bit. We have seen gilt yields retracing some of the earlier gains, but not all the way. We're still up about 7 basis points on the 10-year yield.
Right, and it's got to be concerning, right? Because that market reaction is certainly something you can't ignore. And it seems like up to now the market was, awaiting the budget with a little trepidation, but not too much. I mean, is the Liz Truss moment being invoked here?
I feel like we talk about the Liz Truss moment every time there's a sell-off in gilts, Bonnie. It is the benchmark now here in the UK. This is not that sort of move, but I know from speaking to the Chancellor, she is incredibly wary of the bond vigilantes. She saw what happened to Liz Truss. I think that is why last week we saw her making this speech, rolling the pitch for that income tax rise, and perhaps she is showing the left wing of her party just how important it is to keep the bond vigilantes on side to create that fiscal headroom. So the line about the forecast seeming to tie this up, but we still don't know what's going to be in that budget. So much speculation. And actually, our team on the UK government team say that there's still dozens of policy options under consideration here. Never has the Chancellor left it so last minute to decide what she's going to do, we hear. And Bloomberg reporting on Wednesday that Reeves hasn't been able to make final decisions here because of all of the ongoing arguments inside the Labour cabinet.
And 12 more days to go, Lizzie. Thank you so much. Can't wait to see what happens. That is Lizzie Burden there in London. Now to other top stories trending on the terminal this morning. Minneapolis Fed President Neel Kashkari joining other Fed officials who have expressed skepticism over the need for another cut in December. Kashkari said he didn't support the last interest rate cut. Some Fed officials are arguing for holding rates steady to balance inflation and weaker hiring in the labour market. Ukrainian drones attacked Russia's giant Black Sea port of Novorossiysk last night, prompting a state of emergency. The attacks came as Russia has been ramping up strikes on power facilities across Ukraine, aiming to disrupt the country's energy system ahead of winter. And a bunch of data out of China is showing cooling economic activity at the start of the fourth quarter. Investments slumped at a record pace for the period. Industrial output saw its smallest gain since the start of the year, and retail sales also slowed for the fifth straight month. Coming up, Citi Chair and CEO Jane Fraser discusses the outlook for 2026 in a conversation with Bloomberg TV on the sidelines of the Citi China conference in Shanghai. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Citi Chair and CEO Jane Fraser says the bank is growing rapidly in China with reviving interest from investors and companies in the world's second largest economy. Fraser spoke with Bloomberg TV's Stephen Engel earlier today in Shanghai.
The recent truce has brought some much needed and welcome stability here. I think we're in a position now for both sides that wanted to have a period now where we can move ahead and have a more stable relationship between both of them. It's transactional, but it's in both sides' interests, and we see our client base navigating this well.
Yeah. What's your vision for the China market as it folds into your overall restructuring plan as well? You're now chair and CEO. First time that those two roles have been joined in a couple of decades. Clear mandate to carry out your vision going forward. What does that look like when you did exit your consumer banking business here, like you did in many markets around the world? You also sold your retail wealth management portfolio to HSBC. You got out of an investment bank JV with Orient Securities, I believe, and you have an outstanding license application for your wholly owned JV in securities.
So Citi has been in China for 124 years. We have a landmark building here in Shanghai. And what we have done is focused our strategy and grown. We are following our international clients around the world. We're seeing them with renewed interest and focus in China, as we talked about. And then we're seeing the Chinese companies innovating at pace and also looking at expanding internationally. So we've been growing rapidly here with a more focused strategy.
What is your outlook for Fed action going into the new year and the specter of inflation rising?
Look, I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market, it could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. We all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI, there is, I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one of Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally, and when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labor market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
Are you concerned by what some say maybe bubble forming in AI? We talked about the advantages of AI, but how much of a bubble or overheating?
I'm not sure if we're just in with a lot of our tech clients on the West Coast. I don't think anyone was ready to say that it's a full-on AI bubble, but no one is saying that there aren't some real pockets of let's call it the British understatement, frothiness in the market. It's more around the edges. What I found interesting is we can see a lot of the demand for the infrastructure build that's going in AI and the energy for the next couple of years. Where you saw some opinions diverge was in the 3 to 5 year period, could we be in danger of overbuilding? But no one's feeling that for the big investments that are going on at the moment for the next couple of years. So I think on that one, certainly some pockets of frothiness there on the valuations, but the core infrastructure investments are important. And as we're seeing in our own bank, and I think many companies we'll start getting some of the productivity benefits coming through. But the scale and the pace of investment is unprecedented, that is for sure.
That was Citi's Jane Fraser speaking with Bloomberg's Stephen Engel. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, The New York Times reporting that yesterday's strike in the Caribbean that killed 4 brings the death toll in the Trump administration's campaign against what it identifies as seaborne drug traffickers to 80 since early September. Officials told the Times that Defense Secretary Pete Hegseth was waiting for video of what would be the 20th known strike since Trump authorized military action against drug cartels. Next up, the Financial Times leading with Oracle getting hit harder than its big tech competitors in the latest sell-off. The FT saying Oracle's vast borrowing to fund a pivot to AI unnerved Wall Street. Oracle shares down almost 30% in the past month. That's nearly twice the fall of the next worst performing hyperscaler, Meta. And finally, the Wall Street Journal reporting that Amazon and Microsoft are lining up against Nvidia, the two companies supporting legislation that would require chip companies to satisfy US demand before sending products to China and other countries subject to arms embargoes. Nvidia is fighting the legislation. Coming up, fears of an AI bubble are overblown. That's the view from HSBC's Max Kettner. He'll join us next. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. December cut in question. Fed officials are showing uncertainty over rates, bolstering the Hawks case, potentially for standing pat next month. On deck today, Schmidt, Logan and Bostic. Tumbling. Those rate cut doubts pulling risk assets down. Crude oil rising on mounting worries over Russian flows. And a tariff rethink. President Trump set to lower levies on food items from beef to bananas to address voter concerns. So let's look at that messy board because it was a down day yesterday and it looks to be a down day once again today, at least for equities. Yesterday, though, is a sell everything day. Stocks, bonds and the dollar weakening. The last time that happened was August. We had the S&P down 1.6%, the Nasdaq 100 down more than 2%. Obviously, comments from those Fed officials not helping. Let's take a look at the bond universe because there was definitely a hawkish repricing. As you can see, the 2-year yield at 3.58, the 10-year yield at 4.12. Oh, look at that. The 30-year yield at 4.72. Now, we did have a huge movement in gilts. That was on the board earlier. We did see gilts plunge at the open when it looked like Rachel Reeves was going to do a U-turn on some of those tax increases that she's going to propose in the budget. That move has pared back. I do want to point to some other asset classes. We have gold and silver higher once again, with gold just off now, but it was above $4,200 earlier. Silver is up 10% so far this week, but we still haven't hit a fresh record. And gold is rising above $60 a barrel now. Concerns mounting about Russian supply. The VIX above 21 as well today. Let's get to some individual stocks to watch now. Over to London and Kriti Gupta. Kriti.
Good morning, Vonnie. We'll start off with one of your biggest downside movers this morning, and that's Applied Materials. Shares down about 5%. The stock trading at $212 a share. They're saying that their last quarter was a big pain point. They weren't really able to meet estimates. They're saying this quarter won't be a good one either. They're really pointing the blame at some of those trade restrictions with China, and you're seeing the market punish them for it. Those shares down by about 5%. And bleeding into the broader tech sector on both sides of the Atlantic, I should say. We are, however, seeing some green on the screen, and this is a little bit in the M&A space. Warner Brothers up for sale. Shares higher by 3.5% after a Wall Street Journal reporter yesterday said that Paramount, Comcast, and Netflix were all preparing their bids. In the meantime, the CEO, David Zaslav's contract also getting tweaked to keep his equity share should a deal take place. Basically, all indications are that a buyout may be coming, an acquisition may be coming. Those shares higher by 3.5%. I'll end with one on this side of the Atlantic, Vonnie, and that is Siemens Energy. Those shares off the charts this morning after turbines and data centers helping their bottom line. Those shares higher by 10%.
All right, Kriti, thank you so much. That's Kriti Gupta there in London. Well, the team over at HSBC talking about concerns over a possible AI bubble. The team writing this: despite the drop in tech stocks lately, we remain positive. There's little value in identifying a potential bubble too early. What we see is that there is a potential cliff from 2026 to 2027 as some of the One Big Beautiful Bill incentives fade, but it's far too early to position for that. Joining us now is Max Kettner, Chief Multi-Asset Strategist at HSBC. So Max, what then do we expect between now and when that bubble may pop later on next year? Are we going to see new highs one more time?
Yeah, good morning, and thanks for having me, as always. Look, I think so. When we look at what's driving the S&P earnings, it once again has been tech, but it's actually been also the sort of broad-based surprises. So we, of course, in the Q3 reporting season, have seen once again a really, really good beat rate on the earnings side. We've seen once again a beat rate that was the best one since COVID. So it's not just tech, it's not just AI, but when we look at AI in particular and this question around a possible AI bubble, I do think that people are still underestimating somewhat going into next year and those incentives for CapEx through the One Big Beautiful Build, through the ability to expense CapEx and R&D expenses straight away. I do think that is mega, mega bullish really for AI CapEx, particularly in the first half of the year. What I do remind myself then always is what we are doing at the end of the day is we're probably pulling growth forward ahead of the midterms. Right, and that probably is creating some sort of threat of a cliff event in terms of fiscal and in terms of CapEx from 26 to 27. But just like you were saying, that is possibly 3 to 4 quarters away, minimum 3 quarters, possibly maybe 4 quarters away to position for that. The next leg, the next sort of 6 to 8 months is much more playing the still sequentially really low earnings growth forecasts. When we think Q4 versus Q3, the market once again says earnings in the S&P won't grow, and actually 8 of the 11 S&P sectors are expected to see earnings declines quarter over quarter, and it's only really tech growing. So against these pretty bearish sequential earnings and growth forecasts, I do think there is quite a bit of positive surprises still in store.
Yeah, so Max, what would you do? Would you, take money off the table, wait for an opportunity like perhaps the last couple of days? And bear in mind, it looks bad, but we're still within 3% of our S&P record, so it's not that we've had this huge sell-off.
Yeah, no, I absolutely wouldn't take money off the table. I would do the opposite. You'd have to lean back in. I think it is really going into year end, we most likely are probably going to get a bit more liquidity, whether that is through a drawdown on the Treasury General account, perhaps even getting a little bit more liquidity from the Fed to avoid some sort of funding rate squeeze into year end. That is positive. We've had the earnings just now. We might be seeing perhaps another upside surprise from Nvidia. Let's see about that. But then obviously also any kind of activity data related to the government shutdown, I do think that is pretty asymmetric on the positive side. If we do see some negative surprises relative to consensus expectations in the next 1 or 2 months, I do think the market probably discounts that as, well, it's driven by the shutdown and the shutdown is over. Whereas on the other hand, if we are seeing data either in line or even beating expectations on the activity side, I do think the market will then say, well, hold on, we've had the government shutdown, and despite that, the data are in line or even beating expectations, then that means the underlying growth is perhaps even stronger than we thought. And bear in mind, top down, when we look at consensus expectations, consensus still believes that Q4 is only going to grow about 1% annualized, and Q1 also only about 1.3, 1.4%, the US. So again, it's not just the earnings forecast, it's also top down, where there is still quite a bit of pessimism in expectation.
Max, these new trade deals or frameworks that we're seeing on, individual commodities, individual foodstuffs, first of all, if it happens, will it make any kind of a dent on inflation in the future?
I don't think so. When we look at food inflation, food inflation is running year over year around 3% in the US. And in fact, even in the last 2-3 months, if we annualize it, that is also about 3%. So food inflation has been pretty stable. It's not like, for example, goods inflation that has, of course, been picking up due to tariffs in the last couple of months. So that's not really been the case with food inflation. And of course, also from a weighting perspective, probably food inflation is not as important as other subcomponents, such as, for example, rents and shelter.
Max, what is the Fed going to do? Because we're seeing more and more of these Fed speakers come out with, I wouldn't want to say necessarily hawkish comments, but they are definitely siding more with the standing pat, which then puts them in the hawkish camp. And now it seems like there's only 3 people who might want a cut, or potentially with Myron, more than 1 cut at the December meeting. So, is the market right to be pricing in a more than 50% chance of a cut?
Yeah, so we've still got a December cut in our base case. And I do think, over the next month, if we get a bit of disappointing activity data. The bond market is probably going to lean into that, particularly on the labor market side. So if we continue to see perhaps a bit of alternative data on the labor market disappointing, and perhaps even with the October and the November payrolls, that probably reopens the door for a December cut. Beyond that, in 2026. I really have my issues with the terminal rate pricing and sort of March, April 27 around 3%. I think that probably should be much closer to around 3.5%. And that, of course, does raise then some questions. When does that hurt equities? When does that hurt credit spreads? So when does it hurt risk asset valuations overall? I think the first step is a little bit similar to what we've seen at the beginning of 2024, when the initial repricing was actually taken as a positive, because the initial repricing, if that is driven by better than expected activity, better than expected earnings, the initial move higher in front-end rate expectations, I don't think ought to be negative for valuations. But I think once we go above sort of 3.5% on terminal rate expectations, that then is starting to put a dent on risk asset valuations. But as I said, that is still a long way off.
All right, Max, thank you so much, giving us some hope even if we see a down day this Friday. That is Max Kettner of HSBC. Now to other top stories trending on the terminal this morning. Franklin Resources CEO Jenny Johnson says artificial intelligence is moving quicker than she expected to improve efficiency across the finance industry. Franklin has been expanding its technology efforts, including partnering with Microsoft to build an AI platform. You can catch the full interview on Leaders with Francine Lacroix on Bloomberg Television tonight at 7 p.m. New York time or on Bloomberg.com. Google has offered to tweak its ad tech products to settle a European Union order after a nearly $3.4 billion antitrust penalty. The company will give publishers options to set different minimum prices for bidders on Google's Ad Manager platform and boost interoperability across its ad tech services. NBA star Steph Curry is leaving Under Armour, the sportswear company that has partnered with him for more than a decade. The final Curry shoe for Under Armour will release in February as planned, with the last products from the partnership set to be released through October. Coming up, addressing affordability, President Trump is preparing tariff cuts and trade deals to help concerns on the higher cost of goods. We'll discuss next. This is Bloomberg.
I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. The tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space.
President Trump now taking those steps to address affordability issues by preparing tariff cuts and a series of new trade deals. Joining us now is Bloomberg's Brendan Murray. So first, Brendan, what do we know about what is getting sorted out here with these frameworks?
Yeah, it sounds like they're getting ready to provide some exclusions for food and other kinds of day-to-day necessities that Americans are paying higher costs for. And this is important because it's really the first time that we've heard the White House at least tacitly acknowledge that Americans pay tariffs. President Trump there's been a drumbeat out of the White House that he puts tariffs on China, he puts tariffs on Brazil, but really these are taxes on the American people, and importers have largely absorbed a lot of those costs up until now, but they can only do that for so long until they have to start raising prices. And the Democrats really took advantage of this in the election earlier last week. This whole issue of affordability is really starting to resonate with Republicans in Congress. President Trump, in his inaugural address, said, "I am going to dismantle the things that are causing inflation." And if he's now dealing with an inflationary pushback from the public, then he's seen as out of touch if he doesn't do something about it. So this is what we're seeing is these.
Sorry, didn't mean to interrupt. I'm just curious, how does he get around the Mercosur Pact, right? Because there'd be some overlap here, no?
Yeah, exactly. I mean, this is you heard Kevin Hassett say, trade policy is complicated, and what they've done is they've rolled out these big, broad reciprocal tariffs, hit a lot of U.S. imports with these tariffs, and what they're finding is that they're hurting some of the same people that they're trying to help by reshoring manufacturing. But when you have tariffs on coffee or avocados or mangoes, those just aren't grown in the U.S. and so those can't be reshored. And so what they're trying to do now is to address the things that are hitting the electorate, especially heading into the holidays now when people are hitting the shopping malls and grocery stores.
All right, Brendan, thank you so much. That is Bloomberg's Brendan Murray, our trade czar there in London. And sticking with this topic, the deals unveiled will see tariffs reduced in the US on common grocery items, beef, bananas, coffee beans. The White House spokesperson said in a statement, the Trump administration is committed to pursuing a nimble, nuanced and multifaceted strategy on trade and tariffs. Joining us now is Jonathan Tamari of Bloomberg Government. So we heard Brendan there, the Trump administration obviously hearing voter concerns and definitely seeing, approval ratings plummet. Is that what's behind this sudden sort of U-turn on tariffs and how they are a tax on U.S. consumers?
Yeah, I mean, there's really no other clear line to connect other than the Democrats won significant election victories last week, and then a week later, the president is suddenly reversing course on some of these tariffs after, for months, insisting that tariffs benefit Americans and that the costs are not paid by Americans, which any economist would dispute. So I think that there's a clear connection between these things and Republicans and the president trying to get on the other side of the cost issue that powered him back to office last year.
Will it read through to the public? Will the public start seeing the prices come down in grocery stores immediately? Is it for sure that any kind of deals that will be negotiated will be passed on and that the Trump administration will be able to get that message out, Jonathan?
Yeah, I mean, I think that's going to be the challenge. Are these cost reductions, if there are any, are they passed on? I don't think we know that for sure. The president has not been shy about pressuring businesses to do that, but they don't always listen to what he says. And, we're talking about a small number of goods. So certainly if you buy those things, you'll be happy to see lower prices if it happens. But how that affects the overall picture of prices when, you're talking about housing being in a crisis and other significant cost increases, I'm not sure if that's going to make the dent that necessarily they want, although maybe it's a first step among others.
Jonathan, let's move to this meeting on Tuesday between MBS coming to the White House and obviously the President, Donald Trump. They have a long-standing relationship. There is a little bit of tension now, though. So what would both sides want out of this meeting?
Yeah, so, I mean, this is MBS's first visit to the United States since the killing of Jamal Khashoggi. So or his first visit to Washington, at least. So that's a really notable moment. Saudi is looking for a number of things around the security space, around technology. They're looking for assurances around, they potentially would like to purchase more advanced AI chips. They would like to purchase F-35 jets. They're looking to develop nuclear energy. And the White House on the other side is the president wants to have normalized relations with Israel. He, as we know, is looking to pursue peace. He wants this Nobel Peace Prize very badly, and I think is going to press Saudi to take steps towards Israel, especially now that the war in Gaza has at least come to a halt. So both sides have things that they're asking for here. And as you noted, these two men have a closer relationship often than MBS has had with previous presidents.
All right, Jonathan, thank you so much. That meeting set for Tuesday. Jonathan Tamari of Bloomberg Government there. In the commodity space, gold continues to rise. It's heading for its best week in a month, on track for a weekly gain of about 5% and wiping out losses from the previous session. Joining us now is Bloomberg metals and mining reporter Jack Ryan. And it's not just gold, we have the silver rally as well, Jack. So what exactly are these commodities trying to tell us in the last few sessions?
Well, it's been a really interesting period of time. We've had this kind of crazy rally throughout this whole year, in particularly gold at the earlier part of the year and then silver later on. They kind of both hit a high in October and pulled back from there. And then the last week, they both chalked up gains. Silver in particular has risen more than 9% throughout this week. And there's a lot of reasons for that. It's quite hard to read the market at the moment, but you could definitely say that the backdrop of very little economic data for such a prolonged period of time, you can understand why some investors are looking towards safe havens and looking towards maybe hedging some fears they have in the equity markets. Obviously, there are some big earnings coming up, Nvidia, all these kind of massive companies that dominate the indexes. And so probably there are some investors looking to hedge that. And then there's some of the kind of broader themes we've seen throughout. People looking at the risk of inflation, currency debasement, the so-called debasement trade. I think that is still alive as a theme, and that's motivating some investors.
Now, we keep hearing that, gold is one thing, silver is quite another, because it has much more usefulness in some ways, at least, in industrial America, let's say. So why haven't we seen a record on silver yet?
Well, it's a good question. I mean, yes, silver is very different. A lot of the demand for silver is industrial. Ultimately, it's not as an investment product. And the fundamental picture is quite positive there for silver. We haven't mined enough each year to deliver into the demand, essentially. So we're whittling down each year that passes some of the stockpiles, even though those are quite significant stockpiles. And so investors are looking at that, but then I think more recently it's actually been the investment demand. You can see it through ETFs, exchange-traded funds that are basically backed by a big pool of silver. Investors have been looking at the relationship between gold prices and silver prices. So earlier this year, gold was historically expensive relative to silver. And so there's a lot of people who bet on that ratio kind of reverting, and so they move into silver. And that's probably why silver outperformed gold to the extent that it did through the kind of second half of this year.
Yeah, 10% move this week. Our thanks to you. That is Bloomberg's Jack Ryan. Coming up, we're going to get you set up for your trading day, your Friday trading session. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead for your Friday trading session. Lots of Fed speak on deck once again today. Kansas City Fed President Jeff Schmidt, Dallas Fed President Lori Logan, they speak at an energy conference at 10 a.m. and 2:30 p.m. Eastern, respectively. Then Atlanta Fed President Raphael Bostic, who we now know is leaving, speaks at 3 p.m. And it is the filing deadline for third quarter 13Fs. Let's take a look at some movers in the pre-market. So we have Applied Materials down 5%. It's extending its post-earnings decline. Forecast a drop, obviously, in current quarter sales after suffering a decline last quarter. Warner Brothers Discovery up 3.6%. The Wall Street Journal reporting that Paramount, Comcast and Netflix all preparing bids as the deadline approaches. And Tariff Therapeutics, well, it is on a run. Let's just put it that way. The FT is reporting Merck is nearing a deal to acquire the biotech company developing a treatment for influenza. Now, after yesterday's rough day, this is how we're shaping up today. A lot of red on the screen as well. Not so for the VIX. The VIX is above 21. There's a little green for you. S&P futures, though, pointing to a decline of 0.33%. The 10-year yield roughly unchanged, but we did have a hawkish move across that yield curve yesterday. And gold just barely unchanged, below 4,200. That's it for Bloomberg Brief. Surveillance is next.